Good morning, everybody. Welcome to today's live event. I'm Andrew Wilkinson for Interactive Brokers. Joining me on today's webinar is Jose Blasco, who's the trader and founder at Tradictive. Welcome, Jose. How are you?
Hello. A pleasure to be here, Andrew. I'm very well, very excited as always to be part of this.
Excellent. We've got another large crowd waiting to hear what you've got to teach us this morning, and you're going to address statistics and probability and risk management. Tell us a little bit more, Jose.
Yeah, well, it's all very connected, very related. We're going to be talking about, as you said, probability and statistics linked with the mindset of a trader, the professional approach to trading, understanding the markets from that probability angle, and defining what's an edge and what's not an edge, and trying to separate those human emotions so we can be a bit more robotic, if you wish, when it comes to taking decisions and managing risk. Very important in 2025, obviously, given the levels of volatilities that we've seen, and hopefully the session will be very helpful.
Very good. I'm looking forward to hearing what you've got to say this morning. And just a reminder to the audience, this is a live session. Please do use the chat panel to enter any questions for Jose. We'll do a Q&A towards the end. And somebody's just typed something in there right now. So please go ahead and do those, and I'll keep an eye on those questions. Jose is going to present, and then we'll get to that Q&A towards the end. You'll also receive a link to the recording a couple of hours after we've wrapped up here today. And you'll find on the screen right now, as Jose is just showing, the disclosures and disclaimers from Interactive Brokers in the event we're talking about risky products and so on. So please take a moment to review those. And Jose, you can go on to your opening slide. And I think that's about it. So Jose, please take it away.
Thank you so much, Andrew. As said, a real pleasure to be here. Welcome, everybody. It's also a pleasure to connect with you all, watching this live or recorded. Again, super excited about doing these sessions. Strong passion about the markets, but today, beyond the passion, we're gonna talk about probabilities. In a way, it's kind of like, okay, let's tune it down a little bit. Okay, let's focus on the reality, on, let's call it, on tangible, measurable characteristics of what we have in our hands when we trade, so we can evaluate objectively taking a trade or rejecting a trade, acting, not acting, managing, scaling in, scaling out, all of those various things from the probability angle. It's a very important concept that really separates the mindset of what professionals we do versus what less educated, less experienced traders or more emotional beings may not do, right? So let's have a healthy conversation today, and hopefully it's going to be healthy, extremely educational, hopefully fun as well. And feel free to ask questions, okay, along the session, so we can then take care of all those questions at the end, okay? I believe. Give me a moment. All should be good. So anyway, so let's continue. So the agenda for today, a quick speed of the light introduction, and from there we're gonna talk about the role of probability in trading, statistical measurements, tools that we can use to, in a very pragmatic manner, have some evaluations that are related with probability. Probability goes hand in hand with sustainability, with market timing, with many things of this sort, which we're going to discuss. Then beyond the slides that I have ready for today to go over, let's call it theory and lecture, for sure I also want to jump into the live charts. So we'll be utilizing live charts. I'll do live demonstration, and then we'll kind of recap in the format, whereas everything we are learning today, the idea is to, in the end, have a probability-based plan for you to implement and benefit from approaching trading from a probability angle. As I said a moment ago, we'll talk about tools. So number 7 there, as you can see, free bonus resources. So I'll show you some of the tools and how you can get free access to them, which hopefully can also help you and serve you to be more mechanical, more objective with those probability assessments, okay? that's the plan for today. So again, speed of the light. My name is Jose Blasco. I am a trader. I guess that's obvious. Beyond trading, I am a quantitative strategist. So for me, it's all about data. It's all about approaching trading scientifically, and managing risk. Okay, that's what it is. And therefore, technology, AI, modeling, and everything above and beyond what I just said is what I do. And again, my pleasure to be here. To share all of these with you, but I'll cut my intro short because this really is about you and the markets more than about me. So talking about the markets, to access the markets with Interactive Brokers, you have access to many different platforms. So you have TWS, you have the IBKR desktop, you have the mobile apps. Today, what I'm going to be doing, okay, is I'm going to be utilizing Interactive Brokers connected to TradingView. TradingView being a free platform available out there for millions of traders use TradingView. Is a software that you could download, or you can just use it on a website and sign up for a free plan with TradingView. But then, as you can see here on the bottom part of my screen, I got green light and I got Interactive Brokers, right? Which means that I have clicked on this button and I have added my Interactive Brokers credentials, and that allowed me to log into my account from TradingView. Okay, and I'm gonna use it because many people use it and it's quite easy to use and it's nice, but also because it allows me to do what's called bar replay, so I can go back in time and look at certain market conditions and things like that. So I'm gonna, in order to make this lesson to be richer, I will be using some of those features. And therefore, today, I will be utilizing TradingView connected to Interactive Brokers, okay? Here you can see the 4 steps that you need to connect your IBKR account to TradingView, which is you click on the trading panel, you select Interactive Brokers and click Connect, and then you add your credentials, and then magic, you have the green button that says Interactive Brokers Live, okay? It's that simple. Anyway, so probability. Okay, probability as a trader tool. Well, markets are probabilistic, not predictable. Okay, and let's talk about it, because maybe I just got the attention of some of you by saying something that seems a bit counterintuitive or contradicts, what we hear when we turn on some, TV channel or live video feed on the internet that talks about the markets 24 hours a day, right? We are used to see market analysts talk about, predictions about what they think or we think that market's gonna do. And of course, you need to have an outlook before you trade, and so you can have a specific trade, either long or short, with risk management in place. And in order to do that, you normally have specific belief, outlook, bias where you think the market is going up or going down. So kind of predicting or having a forecast of what's going to happen is kind of needed. But what I'm trying to say here in this slide is that beyond having an opinion or belief, which is something non-measurable, the idea is to think about it in terms of probabilities. It's a very healthy thing to be done, beyond the fact that, next thing you know, our decision process becomes more scientific if you do this. And obviously, scientific is not equal to consistent, but it's getting closer to the word consistent, isn't it? If instead of scientific, I was to, suggest gambling, flipping a coin, depending on how you feel today, you buy or you sell. Depending if it's raining or not, you buy or you sell. Well, probably, probabilities are against us, isn't it? So the idea here is to have a much more scientific approach. And therefore, we are dealing with something which is uncertain, which is the future. With certain tools, we may be able to gain a statistical edge on where our predictions are more likely to become a reality, but it's still not predictable, it's still uncertainty. And therefore, we need to manage such uncertainty through probability, right? Because while we are talking about uncertainty, there are certain things more likely to happen than others. And therefore, that could then be evaluated with a specific number, which is that probability measurement. So a statistical edge means that we expect to win over time, but not every trade. Okay, so as part of this probability thinking for traders, we need to accept realistically, authentically, genuinely that we are not going to win every time, right? So this, by the way, for some of you, because I'm assuming that we have a diverse crowd attending this webinar. So for some of you that have been trading for a while, you know for sure that not every trade will end up as a profit. But for the ones that may be newer to trading, or the ones that may be coming from other experiences, not in trading, such as, you know, let's say an architect, an engineer, you know, professions of that sort, right? Which, by the way, this is where I'm coming from myself before I got into trading. So we are kind of like used to the sure thing, and therefore you expect that, you know, if you have a good setup, you will win. And basically winning is directly related to the setup, meaning that you are not thinking in terms of probabilities, right? You are not assuming or accepting that there is uncertainty in this equation, and that's recipe for trouble. Okay, so we, you know, maybe we need to tap into, you know, our humble side and accept the fact that no matter how smart we are, or how many computer screens we have, or how amazing interactive broker tools are, in the end, we are still dealing with uncertainty into the future, right? So it's very important. So emotional trading seeks uncertainty. It's probably the worst enemy, and emotions are part of being human. And by default, if you don't control it, next thing you know, while you know a future is uncertain, you may be seeking for certainty, and these would very likely lead to over trading or not trading at all, or, you know, making all sorts of mistakes because we didn't think about the markets from a probability angle. We are not evaluating our opportunities and the risk from an angle of probability, as I will do in a moment. So very important concept, probability as a trader tool. Smart trading focuses on setups with repeatable probability advantages, knowing that you're not going to profit from those all the time. But more often than not, probably yes. Okay, that's the idea. So the myth: there is a perfect trade setup that works every single time. It's a myth. It's not the case. The truth is that high quality trades come from stacking probabilities in your favor. So you find setups that profit more often than not. That's great, but it's not going to be every time. Okay? So a professional may be thinking or saying in a conversation, this particular type of setup gives me 60% chance of success with 2-to-1 reward to risk. Now, if you think about this very simple sentence, it says a lot of things. First of all, if you have a 60% chance of success, it means that you have taken a collection of trades, probably a large amount of trades, and you have drawn 60% win-loss ratio from those trades. So in other words, you have a certain level of relevant, I was struggling to find the word relevant. You have a relevant way to measure your win-loss ratio because you have a decent amount of trades that you have taken that give you that 60% win-loss ratio. If that was you, you didn't say, I'm going to win 100% of the times, and you never traded. Or you are not going to say, I make 60% of the times money, but you only took 2 trades, right? So that would make no sense. So the professional mindset implies that you have taken a large collection of trades. Now, only then you focus on evaluating, and you know that the reason why you make money is because you have taken all those trades. Meaning that while you are in the process of taking all those trades, let's say 100 to pick a number, maybe you had situations where you had 8 losses in a row, but after 100 trades, 60% of them were profitable. Right? And because you profit more often than not, and on top of that, every time you profit, it was double the amount of money made versus when you lost. That's what a 2-to-1 reward to risk ratio means. So obviously that professional trader is making a lot of money. But if that professional trader was to get 8 losses in a row, well, while it would not be a pleasant experience, it's not a big deal, because that professional trader knows that after a collection of trades, after a large number of trades being taken, 60% of them made money, right, with a 2-to-1. Whereas the amateur mindset may be, oh, wow, this trade looks good. it has to work for sure. I'm going to use all my money in this trade, right? And therefore, no risk management, no stops, overconfidence, hoping, all of the things are happening because, you know, the amateur mindset was not even thinking in terms of probabilities. It was a belief instead of a scientific approach to measuring the reality of the edge the trader has based on the methodology the trader is using, right? So we need to focus on consistency, not on perfection. So expected value is a very simple calculation which says a lot about the type of trading methodology that a trader may have. So expected value, it's a calculation that takes the win rate. In the prior case, it was 60%, right? So the win rate, how often you profit in percentage. And then it multiplies that times the average profit you collect. And the key word here is average. Again, if you say average, it actually means that you are focusing on a number of trades, right? If you were to look at your expected value by looking at 1 or 2 trades only, then the average makes no sense. It would be non-meaningful. If you only had 1 trade, there is not even an average to be calculated. If you had 5 trades, I mean, yes, you could calculate the average of 5 trades, but it's meaningless. Whereas if you got 100 trades and you calculate the average, and as an average, you make, you know, $350 per trade when you profit. So that number is very, very important because it's telling you what happens, you know, as a normal case. Then when you do the same with the loss rate and you multiply times the average loss, same thing. Now you are taking into consideration what's, you know, what's common for a loss, what's average, right? So now when you apply this formula, the win rate times the average win minus the loss rate times the average loss. So this gives you a clear measurement of you having a methodology that has a positive expectancy, or your methodology is likely going to produce profits. The more you trade it, the more you're going to lose, or the more you trade it, the more you're going to make. Do you have an expected value which is positive or negative, right? So in this example, we have a trader who profits 40% of the time. So you could say, look, it's looking like, you know, this trader is not gonna do too well. Okay, it's looking like this trader is not gonna do too well. But wait a moment, it depends on how much he or she makes when he or she profits or loses, right? So this trader makes $300 as an average when a profit is collected, and loses $100 as an average. Sorry for, you know, this EV should be in a different line. So loses $100 as an average 60% of the times. So when you do the math, 40% of the times 300 minus 60% of the times 100, that's 120 minus 60, that's positive 60. So you would assume that overall, every time you trade, you make $60. It doesn't mean every trade you make $60, but as an average, as long as you keep taking trades and you take enough trades, whereas, you know, probabilities, you know, happen to show in your results, because, you know, if you have a win-loss ratio of 40%, like in this example, but you're only going to take 1 trade and you profit, then your win-loss ratio is 100%, so which is not in line with 40. So you need to give your methodology the opportunity to provide these particular metrics, and therefore you need to take enough trades. You need to have a trade sample which is large enough. So in other words, as an average, even though it's not going to be the next trade, it's going to be after a collection of trades, but as an average, this trader makes $60 per trade every time, you know, proper exposure to a certain amount of trades is taken, right? So a positive EV means long-term profitability. Even if the win-loss ratio is low, as long as your EV is positive, you are good. So this is a very important calculation to be made, which incorporates very basic stats or probabilities, which are the win-loss ratio and the loss-win ratio, right? Now, why no strategy wins 100% of the times? Okay, even if you have this amazing strategy, well, why it doesn't profit 100% of the time? Well, because there is a variation. There is random variation. Okay, I mean, who expected that what happened in April happened, right? The way it happened, on the day it happened. So again, the market was in an uptrend. Next thing you know, the market was in an downtrend. Next thing you know, so we've seen unexpected things all the time. The future is uncertain, and therefore you could think about it as a random thing. Anything could happen anytime. Certain things may be more probable than others. That's why certain methodologies may give you an edge. But even though certain things are more probable than others, the complete unexpected thing could happen anytime. And therefore, even the best setups could lose, and they will lose, okay? So think about a coin flip, right? Let's say you have a bias coin flip, a bias coin that gives you 60% probability to be either, tails or, whatever. Well, could you have cases? You could have cases that even though the coin was biased, you end up with tails 4 times in a row, 10 times in a row. That could happen. And you will be shocked. You will be like, well, wait a moment, my coin was biased, right? It should not give me so many tails. Well, it could still happen. Okay? Nothing stops it from happening. It's less likely, but it could still happen many times in a row. So we must accept those short-term losses in pursuit for the long-term gains. Sorry about that. By giving our methodologies the opportunity to show those statistics by executing enough trades for those results to show, right? Of course, let's say you have never traded before, you have never traded a specific product before, you have never traded that time frame before, you have never traded using a certain tool before, you have no data, you have never done a back test, you have no data. So then you don't know if you're going to be right 40 or 60 or 20% of the times. You have no idea, right? So then, a normal beginning, which, this could be subject for another lesson another day, but a normal beginning would be to do like a proper back test, right? And run, collect 100 samples of trades that you could have taken that you didn't, but at least you could go back in time. Like what I said with TradingView, you could use the market replay function, go back in time and review 100 trade setups using your methodology and document that on a spreadsheet or whatever your preference is, and then evaluate the statistics of those back-tested results. And now you have a base, right? So then when you start trading, you know what to expect, and you just let X amount of trades to take place, and then you should be able to see those statistics, that 40% win-loss ratio, 60% win-loss ratio, whatever it is that you have, you should be able to see it happen. But you should not be thinking on a one trade at a time basis. That makes no sense. So we have win rate versus reward to risk ratio, right? So that's the balance between how often you win and how much you win. What is it that matters most, right? So look at two traders here, trader A and trader B. So trader A makes money 70% of the times, but when he or she makes money, it's a 1-to-1. Or when he or she loses money, it's a 1-to-1. So if you risk 100, you make 100, right? Now, 70% of the times, that's consistent wins. Most of the times you trade, you profit. And therefore, it's low variance, right? Most of the times, you are getting used to get those wins, sometimes a loss, not too often, sometimes maybe a few losses in a row, really not too often, and most of the times you get profits, okay? And that's pretty consistent with low variance. And maybe that's you. And maybe you have a friend, which is B, that only profits 35% of the times, okay? But when that friend makes money, she or he makes 3-to-1, okay? So in other words, most of the time, he or she is losing. But occasionally, you get these big winners. And that's very high variance. That's very high variance, right? Now, what's best? Well, depends on you, really, right? Think about this. So let's say you're a trader A and you go for 1-to-1s, okay? And you take a trade and you lose 1. Could be 100, okay? Let's take a trade, you lose 1, so 100. Let's take a trade, you lose 1, 100. It's very unlikely with a 70% win-loss ratio, but it could happen. So let's say you took 3 trades, you lost 1, and the next trade, you profit 1, okay? So what's the net result? Okay, well, the net result is that you are underwater by 200, and with a 70% win-loss ratio, a few more trades and you are back to breaking even and above. So it should be okay, but maybe not pleasant for you to see that when you lose 3 times in a row, you need to profit 3 times in a row just to go back to break even. You may not be too happy about so much work just to get back to break even. So 70% may make you happy, but what I just explained about now you are underwater by 3 trades and you need to win 3 trades in a row just to go back to break even, that may turn you off a little bit. Maybe not. Okay, it's a matter of your trading profile. Now, if you are trader B, right, you lose, you take another trade, you lose, you take another trade, you lose, right? And you take another trade and you win. Okay, if you do this, and to be honest, you do the math, okay, this is 0, okay, but if you do the math, to be honest, 3 losses, okay, in 4 trades, that is 75% losers, which that is 25% winners. Your friend is better than that, it's 35%, right, which is more than 25%, okay, but let's say that's your friend, okay. So now, is that pleasant? Well, probably it's not pleasant that you did 4 trades and you ended up breaking even. Okay, but the guy on the right did 4 trades and is losing 200. Needs to do at least 2 more trades just to break even. So in other words, the speed of recovery is very powerful here on the right because of the 3-to-1. So those big wins really help. Okay, so maybe your philosophy is that you value that. And because you value that so much, you are actually very, very comfortable being trader B, okay? Or maybe not, okay? Or maybe you are somewhere in between, 50% to 2-1, you name it. There is no right or wrong. In fact, the point I'm trying to make here is, I mean, first of all, everything got pros and cons in life and in trading. But the point I'm trying to make is that you need to evaluate your performance in the form of probabilities as well. What we're doing, very basic stuff so far. You need to evaluate it from that form. So then you can decide if that's good enough for you or not, and what to do, what to tweak. Is your methodology adequate or not? Should you trend trade instead of counter trend trade? Should you mean revert instead of trend trade? You know, what should you do to get to metrics that are what you're looking for? Okay. Anyway, let's keep going. So probability distributions, right? So price behavior tends to follow statistical patterns over time. You probably have heard of bell curves, normal distribution. I'm trying to keep this session quite light when it comes to math, even though we're talking about probability. I haven't even shown not even one formula, right? So I'm trying to keep it, you know, conversational, if you wish. But basically, you know, what I'm trying to say here is that when you look at price action, there are certain things that are more likely to happen than others. Okay, there are certain things that are very unlikely. Those are the outliers. They still happen, but they are rare, okay? And understanding those distributions, you know, what is more likely going to happen, what is less likely going to happen, that's understanding the probability of price. And we can get into super complex quantitative methodologies based on AI to evaluate that, or we can get into very simple applications, just like a Bollinger Band, for example, right? And again, today I'll keep it simple, even though we'll talk about this, right? But the idea is that understanding the distribution of price is certainly very, very helpful to understand or have a better assessment of your entry time, your stops, your targets, and manage expectations of what you think is possible, what is likely going to happen, and trade what's probable instead of trading what you like or what you hoped, or you know, whatever you expected to happen just because you like that to happen instead of because you have evaluated it from a probability angle. So I'll do a quick example here. So let me turn on Bollinger Bands. Okay, so Bollinger Bands is a band that basically calculates an average. Okay, and probably most of you will probably know this, but just in case, the blue line is an average, and the band above and the band below is basically 2 standard deviations above and below the mean. And basically 2 standard deviations, if you assume that price is normally distributed, which is not exactly normally distributed, but it's a valid assumption. So if we assume that's the case, then roughly 95% of the times, price will be inside the band, and roughly 5% of the times, price would be outside the band. So for example, here is price outside the band, inside, 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 and then outside the band, and then inside, 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 and then here outside the band, and then outside the band, and then inside, 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 a little bit outside, back inside, a little bit outside, back inside, a little bit outside, back inside. So in other words, if you think about it from the probability standpoint, being outside the band increases probabilities for price to go back inside, right? So for example, when price was here, shorting is giving you some statistical edge for price to go back inside. I'm not saying to go back down all the way to zero. I'm not saying that, but to go back inside, yes. Okay, or when price is here below, if you were to buy, that would increase probability for price to go back inside. Okay, I'm not saying to go back so far high. That was, I guess, quite unlikely, even though this also has to do with the Memorial Day weekend. So, you know, futures markets were trading where SPY was closed, which is also the reason for the gap. But anyway, let's not overextend the conversation. Let's go back to what we're saying. So I am now looking at price from a probability point of view in a very simplistic manner, but I am. We can certainly employ way more sophisticated methods, right? Another way to think of probabilities, for example, to use AutoClimate, okay, which is one of the tools I'm gonna show you how to get free access for life to it in a moment. So AutoClimate is a tool that shows you what is statistically normal or not. Okay, so let me show it to you. So here we have an AutoClimate here in the bottom part of the screen. I'll show you in a moment how to get access to this, as I said, for everyone. But what is this doing? Well, we got thick dots, we got blue dots, then we got thin dots, which are blue, and also thin dots, which are red. Okay, so thick red, thick blue, thin blue, thin red. So thin means no confirmed. Okay, not confirmed. So not confirmed means low probability. Okay, so that's your answer. Thick means confirmed. That means probability on my side. Okay, so in other words, when it's blue, you want to be a buyer. When it's red, you want to be a seller, but only when the dot is thick. For example, right now, the dot is thin, even though it's red. I don't want to be a seller because probabilities, given the price action, okay, and given the intelligence of this tool, that, you know, the stuff that is happening from behind the scenes, this tool is telling me I don't have probability in my favor. Okay, so even though it's red, you know, doing nothing is probably the way to do it. Okay, but for example, let's go back to this particular moment in time. Okay, so let me use the market replay functionality, as I said earlier I was going to use, and let's go back to, for example, this particular moment in time. Okay, so somewhere here. Okay, somewhere here. So what do we have at this moment in time? Okay, putting on the side that we're outside of Bollinger Bands. Okay, so we already know that from that angle, probably price will want to go back down. But putting that on the side, what do we have? So we have a market condition which is telling you being a buyer carries with it a statistical advantage. But here's what I have not explained yet. When we zoom in, we have two measurements of statistics, which is max distance and count. So let's observe this. A normal thing to happen when this market moves up, when it comes to this, how far it reaches. Okay, we're going to talk about how far, how fast, and how long it took. Okay, we're going to talk about all of this, because if it went too far, if it moved too fast, or if it took too long, in all cases, it would be statistically unsustainable. And statistically unsustainable is against your probabilities, right? So let's take a look. From a max distance point of view, okay, which max distance, okay, is the one above. Okay, max distance. So on an up market, see the up arrow, okay, there is a down arrow here, okay, so let's ignore this one. We don't care about down arrow because the dot is blue, so we care about up. So in an up condition, the fastest it went is 198. Before is not sustainable statistically speaking, and so far it's been 131. So the amount of movement to the upside, it's not that impressive. Okay, in other words, it's still sustainable. Okay, 131 is less than 198, so we're good. Okay, now, okay, not like that, sorry about that. 198 is greater than 131, so we're good. Okay, now from how long it took, which is duration, okay, or count. Okay, whoop. Here we go. So a normal thing to happen for up markets is to move in waves of 6. Currently, it's 5. So it's being up for 5. Okay, 6 is a problem. More than 6, it becomes now not sustainable because it took too long. Okay, the party has been running for too long. You want to join the party now, you're late to the party. Too late. Okay, so probabilities are against you, right? Now, at the moment in time, we're still okay. 5 is less than 6, so we're still okay. Okay, so what would you expect there to happen? Well, maybe keep going higher. Of course, it's outside Bollinger Band, maybe a little bit of a retracement, but still going higher. Now, this is now 6 out of 6. So probability suggests that this is the end. Okay, now, of course, probability is a reference. There is uncertainty. Okay, there is uncertainty. So we're never going to be that precise where, you know, whatever number you see, that's going to be the number. That's never going to be a case. Okay, but the fact that 6 out of 6 is already happening means that from a probability standpoint, you don't have odds in your favor anymore. It's too late. Okay, so what happens next? Well, now it's 7, and notice how, you know, let's say I'm going to put a line here. Okay, so let's say I purchased shares that day, right? I purchased at this price. Okay, and we know probability were against us, right? So notice that, you know, even though it seems that maybe it still went a little bit, okay, now notice that in the end, you know, after a while, you are really not making money, right? And again, we also saw it pierce the Bollinger Band, which is another statistical way to think about price. So you can see this, and this is just a fresh example on the screen. You know, I mean, there are better examples if we look to the left. I just wanted to use, you know, the freshest example I could get, right? So that's an example, okay? And it's very important, okay? And this is also why I want to grant access to this tool to everybody, so you can evaluate price movement with the figures. You know, the red and blue dots are very cute and probably very helpful too. But when thinking in terms of probabilities, the numbers, that's what's going to give you a go, no go type of approval or rejection. Okay, you are thinking in terms of probabilities by looking at that. Okay, so we define the climate either up or down. Thick dots confirm, thin dots unconfirm, but then we end up with more and better decisions thanks to understanding the environment statistically speaking. Okay, so I wanna look into a little bit of live demonstrations here. Okay, so earlier, right before the market was opening, I was looking at some ticker symbols which I want to revisit and see if we can find good examples. So I was looking at AT&T. Here we go. Okay, it's already moving up. I was hoping it was falling, but anyway, let's take a look at this. So I'm gonna enable multiple tools here. Okay, here we go. Yeah, that was a good setup. Anyway, let's explain it. So earlier, when the market was opening, okay, I was using one of the scanners here on TradingView. I was scanning for stocks which are below the Bollinger Band with a change from the open of -5% or so, meaning stocks that opened and kept going lower. So I was looking at AT&T that opened here and then, you know, went a little higher and from there started going down, right? So when I was looking at this, AT&T was outside the Bollinger Band. So when price is outside the Bollinger Band, remember 95% of the time it should be inside. Only 5% of the times it should be outside. So it was there, okay? And notice where we are with the climate. Huge, crazy extension of the climate. A normal thing to happen in a down climate is 5. We are currently looking at 21 candles in a down climate, which is statistically unsustainable. Could it keep going? Of course it could keep going. That's what I meant before. Statistics are a reference, not a guarantee. That's also thinking in terms of probabilities. probabilities are a reference, a guide, a very smart measurement of something that allows you to lean against it or avoid it, right? But it's never a guarantee. So I was looking for very exaggerated situations, because the more exaggerated it is, the more unsustainable it is, and therefore the more the probability on my favor, right? So anyway, so it came into the green and then started moving into the opposite direction. Okay, so anyway, that was an example. Let me see. I also saw with AMT a potentially okay setup. This one is still to play with. Okay, so here we go. This one is still valid. So so AMT, right? So earlier when I was looking at it before the webinar started, this is an 8-minute time frame. I forgot to say that. So the price was outside the Bollinger Band. So I cut this ticker symbol, and you know, I was expecting price to go back inside. Okay, but really, I was looking at the climate. 15 is more than 6. Okay, 337 is more than 2 or 3. So this market went too far, too fast, for too long, and was outside of a Bollinger Band. So could not hold it, came back inside, even though now it's moving back down, right? So remember, the Bollinger Band only tells you you got 95% probabilities of being inside. It doesn't tell you it's gonna go up all the way. So it's good for entries, but not really for targets, right? So for targets and for more precise entries, what I'm using here is another tool that you may have seen me use in other webinars, which is auto UFOs. We can talk about this more in another time. But basically, this is a tool that, also talking about probabilities, is looking at where on-field orders, which is the meaning of UFOs, on-field orders to buy, in this case, may be located. Right. So what I will want to see is I want to see a lot of drama on that stock and accelerate the crash intraday, coming to 209, and from there we should have a massive reversal all the way to 212.65. Okay, that would be, you know, based on how I trade, likely possible. Okay, and not a guarantee, and definitely not trading advice or financial advice or anything of this sort. This is obviously educational purposes and giving you visual examples of what I mean by probability. If this price stretches so much where it goes outside the Bollinger Band, is likely going to go back inside based on what 2 standard deviations and a normally distributed price is, right? Buy orders at this price level, you may want to think about these like this very crazily strong support, and the fact that the climate is extremely unsustainable. All of these add odds in your favor for price to turn and go back higher. Okay, so this is the type of setup that I was planning before the session started to illustrate, right? Now, let me take a look at for the ones of you trading futures, right? Because this is stocks, so just to give a little bit of diversity here. So let's take a look at Euro futures, for example. I was also looking at a potentially nice setup on the 15-minute time frame. I think it was. No, on the 21-minute time frame. No, I believe I got this wrong. Maybe I got my ticker symbol wrong. I'm sorry about that, guys. Yeah, it was not this one. But anyway, let's go back to the slides. Okay, hopefully I made my point. Or maybe I can try to find something, speed of the light, just to love to get another example. Okay, so here we go. So okay, this could be valid. So the S&P is going down since the session has opened. This is a 21-minute time frame of S&P futures. Okay, price is into a green UFO now. Okay, so we actually may see the S&P go back up from here. Okay, actually that's very possible. But if it was to go back down a little lower and get into the next UFO, let me zoom in. Okay, if price was to go back lower into the next UFO, right, at 59.15, so if price was to stretch down here, it would be outside the Bollinger Band. Okay, like it was here before that happened. Okay, and in this case, even though we have red color, the dots are thin, which means that this climate is not confirmed, right? So in other words, taking a trade at 59.15 could certainly be a valid approach to the use of probabilities that I'm discussing today, in the sense that you don't have much probabilities for this to keep going lower so far. And if it was to extend so much that it goes below the Bollinger Band, so, you know, a mean reversion type of opportunity may be available where price goes back up, okay? And then this moving average blue line may continue like this. And when the price continues going higher, so here you could take profits and close the trade, okay? Like some of those little pierces that almost got to the blue line, that pierce got to the blue line, you know, that I'm talking about mean reversion, okay? So anyway, time is moving fast, so I'll go back to the slides just to complete the slides and also to get to the Q&A. Key principles: speed of the light, never reach more than your edge can support. ATR, MAC distance, stats can help define your volatility-based stops. Allocate position size based on probabilities and win expectancy. You may have methodologies that work better in some instruments than others. Maybe you use more money for those trades in those instruments where it works better. Accept randomness, okay? Even a perfect setup can lose. Define trade criteria, have rules on how you do things so you can replicate those trading actions that gave you the statistics that you have collected. You can replicate that with perfection for new future trade setups. So you need rules. Include filters, use expected value calculations to evaluate how good or where are the weaknesses in your methodology, okay? And remember that a single trade doesn't mean anything at all. It's more about a series of trades where now you can get those statistical measurements to give you some sort of meaning, right? If it was only a couple of trades, 5 trades, it means nothing at all, okay? Anyway, so avoiding your statistical edge after a losing streak would be problematic. Overriding setups because you just got this gut feeling or you heard something on the news. Trading outside of defined parameters, I mean, as you can see, all of this is emotional trading, is all over the place, and it would be very problematic. You know, statistics then mean nothing at all, okay? I told you I would show you how to gain access to auto climate. Some of the tools I use in the sessions, you may have seen me use them in other webinars as well. So if you missed it in another webinar, well, this is your chance now to get it. Again, this is something for you just to enjoy and potentially trade better and make yourself more mechanical. So enjoy it. And it's, as I said, it's for free for life. Also, you need a TradingView username, and you can also use their free for life trading plan and then connect TradingView to your interactive broker account. Okay, so it's all good. And now you have your statistics on the screen. Okay. If needed, I'll go back to the screen in a moment. But basically, we are ready now to go to the questions, and the key takeaways would be: markets are uncertain. Trading is about probability, not prediction. There are many tools, UFOs, climate, could be tools that help you as long as you get probability measurements. I didn't show you the probabilities on UFOs. We'll keep that for another day, but you also have probabilities on the screen. Risk management and trade expectancy are statistical, not emotional. And success is process plus probability plus patience. So become a probabilistic thinker, not a perfectionist trader. Okay, and this is coming from someone who sometime in the past, long time ago, was an engineer, and therefore perfection is what I was shooting for. And I had to learn that in trading is not about probability. It's not about perfection. It's about probability. It's very similar in a way to the work or the job of a doctor. Well, I have no expertise in that domain, where, you know, certain drugs work better with certain patients, and sometimes you can heal, sometimes you cannot heal, and, you know, but probabilities are in your favor if you give the right drugs to the right patient, right? So it's kind of like the same idea. Anyway, Andrew, I am ready for questions.
Okay, excellent. Nice presentation, Jose. First of all, William asks, is there a download? Yes, if you go to the handout section of the GoToWebinar panel and expand that, you'll get a link to the PDF and you can download from there. David asks, what sample size of trades is needed for a valuable EV?
Very good. So the very bare minimum would be 30 trades. Okay, in general, in anything that has to do with statistics, if the sample size is less than 30, it's very difficult to draw any sort of a conclusion. So that would be the very, very, very minimum. More is better. 100 would be quite ideal. But yeah, 30 is the number.
Okay. Is a strategy's EV predicated on certain market conditions?
Yeah, so the idea here, maybe I didn't make it clear enough. If this question pop up, I apologize for that. But the idea here is that the trader who collected those statistics had been running a specific plan, meaning that the trader already had a written plan with specific rules that were followed with impeccable discipline 30 times, 100 times, and then produced a specific set of statistics. In other words, that trade plan with that set of rules already defines which market do you trade, which time frame do you use, what time of the day do you apply your methodology. All of this is already part of it, because if not, you would have a lot of randomness within your trading actions, and therefore the statistics again become meaningless. So again, if you're asking this question, I would think that probably you don't have the plan yet. You don't have a plan, or maybe you have version 1 or 2 of your plan, but not a final version. So maybe what you could do is to speed up the process of having a plan or completing your plan, is to run a backtest process where you come up with a basic set of rules, you start backtesting the way you saw me rewind the charts on TradingView. You start backtesting, simulating that you had taken trades in the past, and then documenting if it went well or not. And as you are doing the backtest, you may realize, oh, you know what, I may need to add a rule or two, and then you change or update your trading plan, and you go back and you restart backtesting again. And once you get to 30 samples where you are satisfied with your rule set, so that would be your plan, and those would be your statistics, and you would consider all is valid, and you would know exactly which markets they apply to, on which time frames, at what time of the day, and everything else.
To talk a little bit, Jose, if you will, about time frames. Dimitri asks, does this work on the daily granularity or even lower ones? And Sai asks, what's your favorite time frame for this approach?
Yeah, the concepts that I presented today apply to all time frames. You may be a very, very, very short-term trader using tick time frames, or you may be a long-term investor using weekly time frames, or anywhere in between, daily, 60 minutes, 30 minutes, you name it, right? The concepts apply to everybody. Okay, the concepts apply absolutely for everyone, no matter the trading style. Okay, now, of course, we're talking about a decent amount of samples to have meaningful information out of those statistics. So, let's say you were to use, I'm gonna go to a very much complete extreme, right? So let's say you were using a monthly time frame, right? And like markets like the S&P that have been going up since 2009, apart from a couple scares from time to time, it's basically straight line up since 2009. Well, you could argue that maybe you even get 30 samples there, and it means very little, because you don't have samples in diverse market conditions. The market condition is very similar most of the time. So in other words, the lower the time frame, the more meaningful everything becomes, because if you go to a low time frame, you will be exposed to changing market conditions more often, right? So very strong markets up to the upside in a 5-minute time frame, followed by 2 weeks later very strong markets to the downside, followed by 2 weeks later range-bound market for another week or two, right? You will have all sorts of conditions if you trade the intraday time frames, and you could now collect samples through market conditions, which is more meaningful and accurate versus a very consistent market condition where all the samples represent the same thing, right? So that's part of the answer. Now, which are my favorite timeframes? So I like to be active. Okay, so you saw me today using 8-minute, 21-minute. These type of timeframes are my favorite timeframes. And also, you may have noticed those are Fibonacci numbers. So this is just maybe silly or maybe not, but Fibonacci numbers are something that you could use in many things that you do in trading, including your selection of time frames. So I normally don't use, like, for example, the 10-minute time frame. I don't use it. I would use the 8, because 8 is a fib number, right? This is just a personal preference, and it's also because that way I don't need to think, right? So if I need to pick a time frame, it's not like I'm gonna be like, do I use 15 or 30 or whatever? So I just pick a fib number, and that's it.
John says probability can be calculated. What tool can you use to get a number for probabilities?
Well, probability, if it depends on what, right? So if we are talking about the probability of the win-loss ratio, for example, probably the best tool to use to calculate the probability is just a simple spreadsheet where you have a list of all the trades you have taken, the ones that were above zero, the ones that were below zero, and a simple Excel formula will do the trick to calculate the probability of your win-loss ratio. That's very simple. If you are looking at other sort of probabilities, like for example, what AutoClimate does, where it's giving you a number of what is normal when it comes to what is too far too fast, or what is the normal duration of a move to the upside to the downside. So then it becomes much more complicated. You need market data, you need modeling. So again, there are many ways in how to do it. So I'm gonna give you two answers, because again, we could talk about this. To be honest, this is we could talk about it from the angle of econometrics. We could talk about it from the angle of quantitative finance. So there are many things that we could discuss to answer that question with more detail, which unfortunately we have no time. But I'll mention a couple of tools that you could go and maybe search on YouTube, and that could be useful to you. So number one could be classical linear regression models. So you could Google that on YouTube and maybe find a 10 to 20 minute video that explains that. So that basically allows you to evaluate what's normal and what's not about whatever. So if whatever is, for example, price action or an oscillator information or economic information from the unemployment number, so you can use all that data, put it in that classical linear regression model, and evaluate what is statistically normal or not. So maybe that could be useful to you to watch. And then another thing you could do is Monte Carlo simulations, which is a more sophisticated way. And for that, actually, and you have it on the screen, actually, you have our YouTube channel there on the screen. So I have a video on Monte Carlo simulation in our YouTube channel that could also be useful, I would think, for the audience to think of probabilities in a more powerful manner and not as simplistic as I described it today.
What is the difference between auto UFOs primer versus non-primer?
Yes, the primer version of auto UFOs is an educational version of auto UFOs, which we grant access to our course students. On our website, there is a collection of trading courses for stocks, futures, options, crypto, risk management, backtesting, all of those things. And our core students get access to Auto UFOs Primer, which is an educational tool, is a simpler version of Auto UFOs with less functionality, which makes it easier in an early stage of education. Auto UFOs non-primer, meaning the classic Auto UFOs, is like the full-blown Auto UFOs with all functionality.
Last question, then we're going to wrap up. Do the probabilities apply to Forex?
Yes, absolutely. All markets, it doesn't matter if it's Forex or it's a penny stock or is the bond market or is gold futures. All markets are traded by a set of market participants, which those market participants basically create what I like to call the nature of that market. I have a close friend that likes to call it the DNA of the market. So, there are certain markets that are very volatile by nature or non-volatile by nature, or they move more at that time or they move less at that time. So those characteristics of those markets are set by the market participants. Okay, maybe BlackRock, which is a very large market participant, or maybe the Fed itself, which is the humongous market participant, they may trade a certain asset in a certain way at a certain time, and that generates a certain behavior, a certain nature, a certain DNA for that market, right? So that happens to all markets. It could be a penny stock, it could be Forex, it could be, as I said, gold futures, you name it. So Forex is heavily traded by all sorts of market participants, and therefore the market has a behavior, and statistics will basically help you to measure and evaluate what is normal and not within that behavior, and therefore when it's time to get in, when it's time to get out, with probabilities in your favor. So the answer is yes. I'm sorry to make it a bit longer than what I could have done, but it's a very important point I want to make. Probabilities is for absolutely everything.
Thank you very much, Jose Blasco, founder of Predictive, and thanks to the audience for showing up today. There are a couple of additional questions that I am going to forward on to Jose, and he'll get back to you by email. Thanks, Jose. Bye for now.
This is great. Thank you, Andrew. Thanks, everybody. Bye-bye.